The dogs of the Footsie experimental portfolio comprises the 10 highest yielding shares in the FTSE 100 index, and we last looked at it in July. Back then, the dogs were riding high, comfortably outperforming the FTSE 100 index. In fact, they doubled in value between 2012 and 2017. Over the past months, however, there has been a distinct change in sentiment and performance. Our July dogs comprised oil majors BP and Royal Dutch Shell, housebuilders Barratt Developments and Taylor Wimpey, utilities Centrica and SSE, insurer Direct Line, Lloyds Banking Group, Royal Mail and moneylender Provident Financial. The other two levers, Provident Financial and Royal Mail, have been booted out of the dogs because they are no longer in the FTSE 100 index. However, these issues are compounded by regulatory uncertainty, a slowdown in economic growth and structural social shifts. Sadly too, shares in the 6 remaining dogs have fallen or moved sideways since July. The FTSE 100 index has risen since the summer, even after the recent sell-off. A nominal £10,000 invested in the index in March 2012 was worth £12,455 in July. Today, that figure has risen to £12,580. The dogs are still beating the FTSE 100, but the gap is narrowing, hit by lackluster performances from many of the pups in our portfolio. A bitter battle over staff pensions has been central to Royal Mail's fortune since Questor's income portfolio bought the stock in October 2016. Now the tale has taken another turn. Last week the postal group averted a strike planned by the Communications Workers Union by reaching an agreement over a brand new type of pension scheme. In December, an independent mediator recommended the establishment of a collective scheme that would share risk between the company and staff. Yet if approved, the plans will give Royal Mail and investors far greater certainty over the level of future expenditure. Quaestor bought Royal Mail at 455p. Yesterday afternoon it stood at 470p. More importantly, our £20,000 investment has yielded £1,350 in income so far. With the pension dispute fading into the rear-view mirror, those dividends looks a great deal more sustainable. Resolving the pension issue will also allow the group to make further inroads into Europe. In recent years, IQE, the Cardiff semiconductor firm, has started to look like Britain's next big tech thing. Founded in 1988 and floated in 2000, it meandered along at a middling pace until last year, that is, when speculation about its silicon wafers finding their way into the next generation iPhone sent the shares soaring. That meteoric rise caught the eye of short sellers, whose interest has leapt in the past 6 months on fears that sales of Apple's iPhone X will disappoint and deflate IQE's bubble. By the end of last week, 21% of the shares were out on loan, a proxy for short interest, according to market data. The attack added to a recent sell-off in IQE shares, which fell 3.3% to 104.4p, is valuing it at £788 million. His warning on IQE is worth heeding. It is one tech darling I'd give a wide berth. Avoid